In this week's update, does sell in May still apply? What continues to work well? What's setting up nicely? And Bitcoin now in clear downtrend with overhead resistance in place. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. Okay, let's start with some market perspective. There's this long-held belief that markets are weak from May until September, and you may as well sell everything and go away for all the good that it's going to do. It's a nice line, but it actually doesn't stand up to much scrutiny if you apply the statistics, like so many things in the market. So what has happened in this particular period, because we had a pretty rough March and April, but as far as the indices are concerned, or certainly the majority of the main indices are concerned, there's been no problem at all so far in May, and they've held up pretty well. We've got the S&P just a handful of points off its all-time highs. But look, where it did matter was at the industry group level, because we've still got a market that's performing in two halves. We've got the parts that are trending very well, and we've got the parts that are absolutely struggling, and a few parts that are still basically in downtrend. So it depends very much on what you're in at the moment and not on the overall market itself. Now, Dow transports continue to rise strongly, which is indicative of a strong economy. So they're still doing extremely well. We've just had a breakout in aerospace and defence, which we'll have a look at just in the last couple of days. So, you know, that had been trending quite nicely, but went into a little consolidation, but is now broken out again. And small caps are still performing very well also, which is an encouraging sign. So the challenge for traders and investors, as I see it, is how do we participate in the gains? Because you just don't want to sit on the sideline in this kind of market. I mean, who knows? This market might just keep grinding higher from here with just really small corrections of a couple of percent. So how do we participate and yet hang on to the majority of the gains? You know, that is the essence of the challenge that everybody faces. And there's not one way to do this. There's multiple ways to go about this. And this is where it's important that you are clear about what it is that you're doing. What sort of activity level do you want to engage in? Do you want to be a frequent trader or not so frequent? What level of risk, what level of volatility risk can you undertake? That should perhaps guide some of the selections that you make. So there's all these factors that need to be taken into account. And if you're not clear about them, then this is a very dangerous market to be in if you're not clear about what your game plan is. And we spent a lot of time on this in Portfolio Analyst. Are there still excesses in the market? There's all manner of people at the moment, high-profile people who have got a spectacularly poor record of calling market tops. But they're all yelling from the rafters again that we're about to get a significant top in the market. And who knows, maybe we will. Maybe there'll be something from left field that'll trigger things again. But based on fundamentals and based on what we can see at the moment, that doesn't appear to be the case. Yes, there are a few pockets of excessive value in the market where a few stocks are still being priced at, you know, crazy levels. But just consider all of the following things. Consider what has been absolutely smashed in price since last year. Special access vehicles, which is a way of backdoor listing a company. Renewable energy stocks that had done so incredibly well in 2020 have been absolutely murdered. Marijuana stocks, a lot of innovation stocks that had gone to extreme highs across a number of different sectors. They've all been absolutely smashed in price. There's no excess in those areas anymore. And yet on the other side, consider the earnings results that we've just had across so many sectors. And the forward guidance is as strong as it's ever been. So that's certainly supportive of, of a market holding together. And consider how quickly the super high growth multiples are falling. I think I did an exercise a week or two ago on this, where if a company's growing its revenues at 100% plus a year, then what looked expensive in 2019, 2020, by 2022, which the market will start pricing in reasonably soon, in 2022, those stocks are looking downright cheap because the revenue growth is just moving ahead so rapidly. Also consider the air of caution that there is at the moment. This is hardly a bullish sentiment environment at present, and you don't tend to get major tops, or you almost never get major tops when there's an air of caution around, and we certainly have that at the moment. So for me, this is just not a time when a major top is likely to form. So the probability is relatively low. We all got broadsided by COVID in February of 2020, February and March of 2020. That was something that came out of left field. But barring something, the re-emergence of something like that again, then the probability of a major top is just not there. I think the biggest risk remains policy missteps on the part of central banks and governments. That's the biggest risk that we face. Now, the astute way forward, I believe, is as long as it's trending higher, so let's get some diversification in here across different sectors, as long as every single one of them is trending higher. I don't think you want to be in anything that's not trending higher at the moment. It's just the way the market is. It has changed quite significantly, where technology led for much of 2020 and until November, when the vaccination became available, and since then has been an abrupt change. So stay with what is working now. So what is working? Well, disruptive technologies. Yeah, they're a little bit easy in price over the last couple of months, and that might continue for a little bit longer, but the businesses are still going ahead very nicely. They're still causing enormous disruption. They're still changing the way that business is done, and those companies will thrive in the future. So that's certainly one area, maybe not right now, but certainly you don't want to lose sight of disruptive technologies. Both hard and soft commodities across a number of different areas. So it's agricultural, it's base metals, it's copper, it's battery materials. It's a whole raft of different things fall into that category. And the outlook there is still remaining very buoyant. Infrastructure building, obviously, with massive amounts of government spending and stimulus in that area set to continue for years and years to come. So infrastructure should do well. Finance is obviously doing well with the yields rising and with the expectation that yields will probably rise further. And of course, semiconductors, the outlook for semiconductors just remains incredibly robust. There's a few supply chain issues at the moment, but by and large, the outlook for semiconductors is very, very strong. So if you can get a mix of those sorts of sectors and stocks, then I think that looks very appropriate for what is coming. Let's turn now to American stocks. The S&P was higher by 1.2% for the week. And whilst it's really in a bit of a consolidation patch, it's proving to be very resilient. And that's because we've got this balance between the sectors that are doing very well and the ones that aren't necessarily trending at the moment. And so you put the two together and we end up with a market that's just really going sideways. From my perspective, following the charts is the only way to proceed, because trying to guess what the future might be or how things might unfold is really a bit of a mug's game. You've really just got to follow what the money is actually doing, not what the money is saying it might do. The US dollar steady at 90.03. The 10-year yield eased a little bit, and that helped technology stocks towards the end of the week. And the VIX, which had spiked to 27 a few weeks ago, all the way back down to 16 again now. So let's jump in and take a look at some charts. And we'll just have a quick look at Bitcoin. So this is what I said last week. The reality of the market is that recent buyers will now create, so buyers that have been caught buying up in these areas up here above, let's say 45,000, they're going to create an overhead resistance to any rallies. So, forget the fundamental outlook for Bitcoin, whether you like it or don't like it. This is about human dynamics. And this is exactly what's happened. So selling every time Bitcoin bounced to the 200-day moving average, selling just poured in again. And you can see Friday, the market hung there for a couple of days, but the selling poured in again on Friday. And I don't know where Bitcoin goes from here. We've got a key support level here around about just tick under 30,000. I wouldn't be surprised to see it break, but equally I wouldn't be surprised to see some sort of volatile consolidation zone in this area here. But certainly, Bitcoin is the price of Bitcoin in the short to medium term is a real lottery. I have no idea which way it might head from here, but certainly what we can say at the moment is that the trend is down. We've broken multiple support levels, and it's looking pretty dicey. Now let's look at the S&P. It's the big picture on a monthly chart, but zeroing in on a daily chart, and you can see we're really just sitting at the same level that we were at in the middle of April. So we've had about 6 weeks now of consolidation, but the bigger picture trend is obviously still quite nicely higher. If we look at the NASDAQ, it's a little bit further off its all-time highs, but still not performing too badly. I'll look at the normal important spreads. So this is growth versus value, and again we're still in this sideways range between 1.54 and 1.67, and until that resolves one way or the other, I think we're going to continue to have the sort of market that we've seen in recent weeks. And the other important spread, of course, is consumer discretionary versus consumer staples. And we've seen staples do a little bit better in the last few weeks, and that's really points to the point I made at the start, and that's there's an air of caution around this market. This is not a market that's frothy and excessive, and therefore liable to some sort of selling. Looking at some of the other sectors, so if we start with the finance sector, so this is XLF. Sorry, that's the wrong one. Okay, there's the US finance sector. So you can see the trend here is very, very strong. It's still holding above the 20-day moving average, which is a sign of real strength. So certainly that continues to do very well. This is materials, which covers a number of different industry groups, but materials going very well in the US. Energy had been trending very strongly, but just seems to be losing a bit of momentum at the moment. So a bit of a divergence happening there with energy. And this is the aerospace and defence sector. So you can see we've had quite a nice uptrend already in place, but then we've just got this quite nice short-term breakout, and it was a pretty robust breakout. When you really zero in, you can see some really nice volume on the breakout on Thursday, and that was a very definite move. So aerospace and defence looking much better as well. Turning to Aussie stocks, our dollar fell to 76.64, and it may well be that the forecasts about the iron ore price might be having an impact there on the Australian dollar, because certainly during that period the US dollar was essentially flat. Our market index gained 2.1%. So new highs, banks and healthcare led the index. Materials were still lagging, but there was a nice turnaround on Friday in some of the materials majors. So the US dollar, as you can see, still holding this this critical support. But if that breaks, we've had a number of goes at it. If that breaks, then we could see quite a sharpish move in the US dollar down into the mid-80s. So this is a very important level. And the Australian dollar, as you can see, we had a bit of a gap down on Friday. So turning now to our index, and you can see quite a strong move on Thursday and particularly on Friday as well. Turning now to precious metals, gold had another very good week, up $22 and breached 1900 and closed above it. Silver also up slightly to around $28. The next major hurdle, as I indicated last week, for gold is around 1960, and certainly the trend is very strong. And if we look at GDX, we're just getting a bit of a consolidation now, and as long as gold keeps moving higher, then I'm sure there'll be another advance coming for GDX. So let's take a quick look at those charts. So there's gold on the weekly chart. So we've certainly bounced very nicely off this 38.2 retracement level, and we're now getting back up to some really important resistance levels. Looked at on a daily, you can see there's a very clear uptrend there in the gold price. And silver, just to complete the picture, had been outperforming gold. Silver held up really well when gold was weak, but now that gold has gone back into uptrend, silver's been lagging just a little bit. Other commodities, copper and nickel, were on the rise again after getting a bit of a beating over the last week or two. So copper back to 4.69 and nickel back above $8. And copper, it's gained 17% in the last 2 months. So even though we did have a bit of a pullback there for a couple of weeks, the medium term for copper looks very, very strong. Now crude oil went higher to 66.9. And the US energy sector certainly offers some opportunity relative to the Australian sector. America is performing much better, but yeah, just losing a bit of momentum of late. So I still see energy as being a bit of a high risk sector. There's the spot copper chart, so you can see a nice bounce last week. The same in nickel. And just to wrap everything up, my final thoughts on the week. There's always concerns around the market. You know, we never have a period where the market's just really happy and nobody sees any dramas on the horizon, or almost never. And generally, when you're in that sort of situation, you generally want to be getting a little bit concerned because that is often close to market tops. So there are always concerns. There's always something the medias can play up. There's always something we can wring our hands about. And no strategy works 100% of the time. You know, it can't be done. So therefore, you need to remain open-minded and ready to adapt. I mean, who saw COVID coming and then the market response to it? You know, who saw the global lockdowns, the amazing recovery that we saw in markets in 2020? So, you know, who knows what the future might hold? So it's so important to be ready to adapt. Things continue to change very quickly, not just because of technology, but because of the global response to, to what has been an extraordinary event. The best advice I can give to traders and investors is not to worry about the things that we can't control. There's no point, just simply focus on what we can control. And there are numerous things that we can control. Our level of exposure, the stocks and sectors that we're in, the game plan that we employ, you know, how we get in, how we get out. We can control most things in the market, so just focus on those things. Portfolio analyst last week, we looked at things that you can do when you're stuck waiting. So if you're more of a longer term investor, it's been a bit of a waiting game the last couple of months, but there are things that we can do in the shorter term to make some progress on the market. So we focused on that. We also looked at uranium sector and some stocks in the uranium sector, which is obviously poised to do very well. And also strategy and patterns to look for around shorter term trading. So I think it was a very productive sector, very productive session, I should say. So we'll be doing something similar in Portfolio Analyst this week for anyone that hasn't had the opportunity to take that trial yet. There's my website details and email address for anyone that wants to contact me, and I'll be back with you next Sunday. Cheers.